Hello and welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Kevin Wadsworth of Northstar Badcharts. We're going to go through Bitcoin and a bunch of things in the precious metals market. Kevin, thanks for taking time out of your day today.
Yeah, no problem at all, Rob. It's nice to meet up and have a chat about what's going on in the markets. It's pretty amazing stuff taking place in some of the markets at the moment. It's very exciting for those particularly invested in cryptocurrencies at the moment. And perhaps we can put that into some sort of context and explain to people what technical analysis is and how it works. I guess some people aren't all that familiar.
No, absolutely. We always find that there's a lot of people would go into a lot of the technical. Some people just have a look at the main, news headlines and try and put two and two together. What I would say is what we're going to talk about today for people listening to this in podcast format. You might want to head across to X or Substack because there's going to be a video of this, and of course, when we go through the charts, might make it a bit easier for those that are listening to this on podcast format that want to see the charts. Kevin, there's really only one place to start. Just to date stamp it, we're recording this on the 5th of December. This is going out on the 5th of December as well. But overnight, Bitcoin hit over $100,000, which, again, a lot of people are picking up on. Quite big news. But what are you seeing on the charts and what are your thoughts on Bitcoin and cryptos in general?
Okay, Robert, I'll start with sharing a screen here, and perhaps you can just confirm for me that you can see the Bitcoin chart, just to make sure I'm
Yeah, I can see that.
sharing the
That's
screen. Okay,
yeah.
good. That's always encouraging. Right, well, this is the Bitcoin 4-hour chart, and if you're not familiar with technical analysis, I'll just explain for you that there are particular patterns that form on technical charts that repeat over and over again. Okay, and these patterns are not just random, they're not just sort of figment of my imagination. They're created by a combination of human traders and algorithms that are trading, on behalf of investors. So those algorithms know very, very well that there is a resistance level, or was a resistance level down here around about 97,400, and that had been formed by previous price action. As the price went down, it formed a resistance line on a technical chart. So what happens when the price just edges above that level is that the buyers come in because they spot it. And when I say the buyers, I'm talking about human traders and those algorithms which are pre-set to buy and sell, whether it's stocks and shares or cryptocurrencies. So you get a sudden wave of buying, and that wave of buying encourages more buying, and those on the sidelines start noticing, and more buying begets more buying. And then what's happened overnight, as you say, Robert, is that we've crossed the area that is approximately $100,000. In fact, it wasn't exactly 100,000, and there's a very good reason for that, but the psychological level is $100,000. If I zoom right out onto a weekly time frame and just do this with the chart for you, just give me a second to zoom right back out. Now you can see the red line there, and if you cast your eyes back to 2021, if you join the peak in April 2021 to the peak in November 2021, you're just joining 2 points, okay? And you can join any 2 points with a straight line. They have no meaning because any 2 points on this graph can be joined together with a straight line. But projecting that line forwards, what do we see? What we saw, and if we zoom right in, is a reaction at that red line, which makes that red line valid. And if I pop it back onto the candle chart, this is a line chart with a black line showing the price action. If I just pop it back onto the candles, you can see that green candle there hit that red line and stopped. And then the next weekly candle, this red one here, they're called candles, by the way, these figures on the chart, these shapes on the chart, it represents the price action going up and down, and it forms this what we call a candle. You can see this red one formed just below the 100,000 level. So it told us that that line was actually acting as a critical resistance level. So if I zoom back into the 4-hour chart, you can see that that was confirmed by the breakout above that 100,000 level. We actually tested it tested that level close to 100,000 level on that 4 hour candle, and then we broke out. So this is what we call a technical breakout, and it's not just the Bitcoin price that is relevant here, because Bitcoin is priced in US dollars, and US dollars, as we all know, are depreciating at an increasing rate. So the purchasing power of the US dollar is diminishing at a almost exponential rate. So what we're dealing with here is we're pricing everything well, effectively in confetti. We're pricing it in paper that is losing value itself. If you really want to, on a long time frame, get a proper picture of what really is going on, you should be pricing things in gold. So this is Bitcoin priced in gold, okay? And why price it in gold? Well, price it in gold because gold is much more stable, okay? If you look at gold versus the US dollar, of course, gold has gone up from $25 to $250 to $2,500, and that's as a result of, primarily the loss of purchasing power of the US dollar. Gold isn't going up. Newsflash, gold isn't going up. It's the dollar that's going down. Gold just sits there doing nothing. It's a barometer. Gold measures the health of the currency. It's as simple as that. So one way of looking at it is that gold is, the ultimate currency. It's unaffected by, over the long term, unaffected by government shenanigans. I know people scream manipulation with gold, but that may well take place in the short term. But ultimately, what gold does over the long term, it reflects purchasing power destruction. So if you're going to price things, price it in gold, and that's easy to do on all your technical chart software. This is TradingView. All you have to do is BTC USD, Bitcoin, slash XAU USD. So it's Bitcoin priced in gold. And what you end up with is a more realistic representation of what Bitcoin is doing in terms of its, I'll use the word value, okay, not price, but its value. And it also enables you to maximize your gains, okay, because why sit through a drawdown when Bitcoin goes from well, let's say, 70,000 down to 16,000 or whatever it was during the last bear market. Bitcoin commonly, repeatedly loses 70% of its value in a bear market. So why sit through a bear market in Bitcoin when all you need to do is swap to gold? I'll give you an example. Earlier on this year, this chart broke down. We told our members to swap to gold. I even put it out on X and said that Bitcoin had broken down versus gold. So at that point in March, April of this year, you should really have swapped to gold and watched your gold go from 2,100, 2,200, 2,300, all the way up to nearly $2,800. And then again on X and in more detail for our website members, we suggested that, or we told them that Bitcoin was breaking out versus gold. And that was somewhere near the 73,000 level. That was the point at which you should be swapping your gold back to Bitcoin. So effectively, what you've done is you've gained whilst Bitcoin's gone up. You've gained whilst Bitcoin's gone down because you weren't in Bitcoin, you're in gold. So you increased your portfolio by 20, 30, 40%, depending on how well you timed it. And then you've gained again because Bitcoin is, the Bitcoin has gone up versus gold. So you are making more money in Bitcoin than you would in gold. I mean, gold hasn't really gone anywhere. It's stuck around 2650, it's just below $2,700. So even though gold hasn't fallen much, it is underperforming Bitcoin because Bitcoin is shooting upwards. Now, the important point to notice on this chart is a cup and handle pattern. You can see the cup, you can see the handle, and these are well known in technical chart analysis as bullish patterns. By bullish, I mean that they resolve to the upside. And the cup and handle broke out. And not only that, but now we're breaking above the horizontal resistance that's created by the entire pattern that goes all the way back to 2021. Price hit that level. Bitcoin versus gold reached that level. Then it reached it again. Then it pretty much reached it again. then it reached it again on this candle here, and now it's broken out. So what can we say? What does it mean? What it means from a technical analysis point of view is telling us that we are now in the final phase of the Bitcoin and cryptocurrency bull market, because we are now in the final stage where Bitcoin outperforms gold to an increasing degree, but there's a question mark over how long it will continue to do that for. And I'll explain that to you using this chart. Again, this is, instead of Bitcoin versus gold, it's gold versus Bitcoin. Okay, so when you do a ratio chart, the first term, in this case, it's gold, and the second term, Bitcoin. Okay, so the first term, gold, if the chart goes up, gold is winning, the first thing that's mentioned. And if the chart is going down, then the second thing that's mentioned in your ratio pair is winning. So if this chart's going up, gold is beating Bitcoin. If the chart is going down, Bitcoin is beating gold. Okay. Now, overall, you take a step back, you can see that Bitcoin has beaten gold by 500,000%. Okay, but that's because Bitcoin started off near zero. So it's very easy to move, hundreds of thousands of percent when your starting point is nearly zero. Okay, so that's one thing to get out of the way. And that's what Bitcoiners and crypto fans will always point to. Oh, Bitcoin has outperformed gold by hundreds of thousands of percent. Yes, it has. But looking in the rear view mirror is not helpful. Or how can I put it? Looking in the rear view mirror and expecting the same to carry on, ad infinitum into the future is not the correct thing to do. The correct thing to do is look at what the chart is actually telling you. Okay, so I'll tell you what the chart is saying. When you have these red candles, Bitcoin is winning, as I've said. And then when you get the green candles, the chart moves up, gold is winning. So you can conclude a few things from this chart, and I'll give you some true statements. The first true statement, obviously, is that Bitcoin has massively outperformed gold since it's existed. Second true statement is that during each bull run for Bitcoin, the subsequent bull run is both shorter in time and shorter in distance than the previous one. So these blue lines that you can see highlighting the breakdown of the ratio and the subsequent final bull run phase, they are getting shorter in time and shorter in distance. And you can see the last one here in 2020, when this ratio broke horizontal support, only lasted for 1, 2, 3, 4 months. Okay, the previous one lasted for 1, 2, 3, 4, 5, 6, 7, 8 months. The one before that, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months. And then clearly the one before that was much longer. So the time period that Bitcoin is drastically outperforming gold is getting shorter, and the actual amount of outperformance is getting less. So we're losing momentum. Okay, now can that change? Yes, it can. But there's no reason to automatically assume that it will. Okay, so that's something to be aware of and have in the back of your mind as this begins to break down. So it's a little warning sign, and as you can see, this little black line here on the chart that we experienced earlier on this year, and this is the period of outperformance for gold versus Bitcoin that I was showing you on the previous chart, where for several months of this year, gold outperformed Bitcoin by about 60%. So gold outperformed Bitcoin by about 60% for several months this year, but clearly we've broken down now, and Bitcoin is outperforming gold. So in conjunction with that sort of slight sort of warning signal, I just want to show you this. This is called the yield curve inversion. Okay, so this is the 10-year yield. So this is the yield on the US government 10-year debt minus the yield on the 2-year bonds, the 2-year government debt. So normally this is in positive territory above zero. That red line along the bottom is the zero line. So normally, as you can see, the 10-year yield minus the 2-year yield is a positive number. That's because the reason the 10-year yield is bigger than the 2-year yield or greater than the 2-year yield is because if you're going to um, you know lend somebody some money over a longer period of time, you need to pay a higher rate of interest over a longer period of time. A short duration debt should be less risky. Okay, so there are times when that number goes negative, and the 10-year yield minus the 2-year yield is a negative number. So the 2-year yield is larger than the 10-year yield. Okay, and that's because of inflation fears or fears of, immediate fears over what's likely over the next 2 years. And that pushes the 10-year yield minus the 2-year yield into negative territory. Okay, that's all fascinating and probably quite confusing, but just looking at the chart and making some simple conclusions, what we can say is that when the chart is below the zero line and then comes back above the zero line, interacting with the zero line, something bad happens soon afterwards. And these green zones show you the US recessions, and the annotations on the chart show major crises that occurred at the same time. So history tells us that going below the zero line, and the further you go below it, and the longer you're below it for, the bigger the event, the more serious the event, and the more serious the impact on the stock market. So we were below the zero line for over 2 years and have only just recently come back above it. So what I'm saying is that this one chart, this one piece of evidence, obviously you need lots of other pieces of evidence. This is just part of the picture, but this one piece of evidence is suggesting that something unpleasant is not very far in the future. So the clock is ticking from that point of view. Now, without being the boy who cries wolf, you can't just be scared of your own shadow and not be interested in the stock market and cryptocurrencies, because when this event comes along, we're looking at a stock market. I don't want to use the word collapse. Well, yeah, stock market collapse, a huge stock market drawdown, and that will take cryptocurrencies with it. But there's no need to be scared of your own shadow here, because until the actual chart for the S&P or the Nasdaq or Bitcoin actually shows some weakness, then there's no reason not to partake in all the good stuff that's going on. But it reminds you to have sound risk and money management processes in place so that you are not risking too much should things turn south. In the top left-hand corner, you'll notice this matrix, and this is a matrix that I've stolen from my background in meteorology, where we issue an impact matrix for severe weather events. And that impact matrix is an assessment of the likelihood of an event and the impact of that event should it happen. And any of you who are involved in risk analysis and risk management in the world of work or whatever will be familiar with these sort of impact matrices. So what I'm saying is that the likelihood of an event is high because this chart is telling us that there is an event coming. And what I'm also saying is that the impact from that event will also be high. So it's a high likelihood of a high impact event, as suggested by this particular chart. And the time frame for that could be, well, it varies, but this recession kicked in about 3 or 4 quarters after the chart moved above the zero line. So it's about 12 months after. But on other occasions, the recession takes place almost immediately. It's maybe 1 or 2 quarters after, so 3 to 6 months. So far, we're into the second quarter after this chart has moved back above the zero line. So the clock is definitely ticking from the evidence on that one particular chart. We can then take that forwards with the individual charts for the S&P and for gold. And if we look at gold, this is the gold chart going all the way back to the 1980s. And a little bit like the Bitcoin chart that I showed you, I'd previously joined 2 peaks on this gold chart and extended it forwards. And I did this, a year or so ago, just with the hunch that when we hit this level around 2,800 on gold, we would hit resistance. And there's a lot of other reasons why I suspected that would happen. So we alerted our website members to the breakout when it took place down near $2,100. And I also posted that on X. And the projection at the time, or the forecast from me and my colleague Pat, was for a move that would be what we call a measured move. And the measured move is simply by measuring the distance from the previous breakout to the peak. That was a release of energy, and then taking the same measured move to the to the current situation. And we can also use Fibonacci, extension levels, and a whole load of other mathematical techniques. What you end up with, Robert, is a sort of every technique gives a different target. Okay, so you go through a whole series of a whole process of this technique gives that target, and this technique gives that target. What you end up with is a bullseye like that. Okay, and you end up with a range of targets, and you assess all those targets to try and home in on the most probable destination for the move. And you do that when it breaks out. So, sort of 6 to 8 months ahead of it hitting that peak, we had already done the work to tell us where that peak would be, or would most likely be, because it is a game of likelihoods and probabilities. There are never any certainties in this world, but we're playing with likelihoods and probabilities, and by doing that, you can increase your chances of growing your portfolio rather than seeing it diminishing in price. So we identified a target level of initially 2660, but then as the moving averages moved up, that target level edged up towards the 2800 area, and we eventually peaked at 2790 on this particular exchange. So 2790, so very close to 2800. So that was the target hit. So at that point, what do you do? The correct thing to do is to take profits off the table. So if you're trading this, and by the way, there's a big difference between trading and stacking. You have to decide right at the outset: are you a stacker or are you a trader? Are you an investor or are you a trader? What I mean by that is, are you prepared to wait 20 years to grow your gold from $250 to $2,800? If you've got a time horizon that is decades long, then what you do is you just ignore all the pullbacks in the knowledge that gold is tracking loss of purchasing power. And when you get a large pullback like this, you just add to your investment, you add to your stacks of gold and silver. But if your timeline is more, I don't know, 1 year, 6 months, that kind of thing, then you enter the trade when it breaks out, and you take your profits off the table when your target is hit. Okay, so the target was hit. So for those who are trading, you should take your profits off the table and wait for this to resolve. This is resolving it in conjunction with what's happening with cryptocurrencies, because when gold hits resistance and pauses, Bitcoin surges. And when Bitcoin hits resistance and either pauses or enters a bear market, gold surges. So if you look back through the charts, you'll see that that's true. So Bitcoin will surge when gold is pausing and correcting, and vice versa. So gold hitting its target and pausing and correcting goes hand in hand with Bitcoin breaking out and having its final move, which may only be a few weeks long. I know a lot of people are expecting it to go well into maybe Q3 or Q4 of next year. I doubt that. It may happen, but I doubt it. And I suspect that this particular run for Bitcoin will be measured in, well, maybe not so much weeks, but 1 to 3 months, I will say. Okay, so a 1 to 3 month run is what I expect. But I'm fully prepared and positioned to, ride the move higher should it continue higher. If it goes on for 6 to 9 months, that's absolutely fine. But my suspicion is that it will fail before that. But still give time for the altcoins to have some very exciting runs, and some of them have already. Silver this is the silver roadmap that we put out in 2020 as the COVID low was put in place. It became obvious that a classic arc pattern was forming, which is a perfect geometric arc. It's not manipulated anyway. It's a perfect geometric arc that provides support, just like any other support line. And in fact, if you zoom right out, that is actually just a handle on a much bigger cup and handle pattern that's been forming since 1979.
Wow.
So silver finds itself in a cup and handle pattern. Now, I was talking about Bitcoin a moment ago. Its cup and handle has just broken out, but that cup and handle pattern has only been forming for um, a much shorter period of time. I can't even remember how long that pattern covered in Bitcoin, but it was a very short period of time compared to silver, which has been forming its cup and handle pattern over 50 odd years. So when this breaks out, you can imagine the magnitude of the move that is projected to take place through the technical analysis. So, 38 to $50 silver might sound like, quite a high price for silver, but the chart suggests that in the years that follow, for whatever reason, silver is going to rapidly accelerate in dollar price. It seems to be taking forever, but don't forget that in 2020, silver was only $14. Okay, so yeah, I mean, it's nothing compared to cryptocurrencies that go up, 100% in a week. But nevertheless, we've gone from 14 to over 30. So, if you're just wanting to grow your portfolio at 20% a year, which, a lot of people would be very happy with 20% a year in their retirement portfolios, then silver is doing a great job of that. And that is likely to accelerate and increase in terms of the percentage gains going forwards. One just special mention for precious metal miners, and I can't, sort of emphasize this strongly enough. This is the ASA index, gold and silver mining index. I'm using this because it goes back 50 years. If I was to overlay GDX onto the chart for ASA, they're exactly the same. They match perfectly. So GDX, which is a gold mining index that everyone's familiar with, exactly tracks ASA. Okay, so it's a valid thing to do to use ASA instead of GDX because its price history goes back further. Okay, so now if we use ASA versus gold, now remember what I said before, if the graph is going up, the first term is winning. And if the graph is coming down, the second thing in the ratio pair is winning. So the graph is very much going down. In fact, it's fallen by 95%. So ASA, the gold and silver miners, have lost 95% of their value versus gold over 50 years. And there are only short periods of time, usually just a year or two at the most, where you get rapid outperformance for the gold miners compared to gold. So the overall message is, until this chart does something to prove it, then the probabilities suggest that holding gold or silver over a long time frame will be a safer bet than holding the miners. And there are all sorts of reasons for that, all sorts of fundamental reasons that you can get into around the miners being affected by input costs, being affected by labor costs, but being affected by the oil price, whereas the metal itself is always going to be valued because of its rarity and because whatever. But the miners that are poor old miners that are pulling the stuff out of the ground, they have a lot of other issues to worry about. So yes, I mean, buy the miners when they break out versus gold, and we can use technical analysis to identify exactly when you should be buying the miners. But if you don't time it right, and you're not using technical analysis, if you're just listening to some talking head on King World News or Zero Hedge or some, website or other saying, "Oh, the miners are going to do this, the miners are going to do that," and unless you're using a technical chart to pinpoint precisely when they break out, I'm afraid you're very likely to lose a large part of your investment. Capital rotation. I think this is probably the last thing I want to mention. Capital rotation is something that takes place in the markets, between different asset classes, and it's clearly identifiable using a technical chart. You can follow this chart all the way back through the years, and you can spot these rotation events. There's one there in the 1970s. chart breakdown. Now, there's a lot of evidence you can get from other technical charts that help you to identify a rotation event. And a rotation event, this is gold versus the S&P. Okay, so when it goes up, gold is winning. When it comes down, the S&P is winning. The stock market is winning. Okay, so during the 1970s, gold massively outperformed the stock market by 1,500%, roughly. And then the chart breaks down. You get a lot of evidence from other charts that you should rotate away from gold, precious metals, into stock market and general equities. And then for many years after that, gold was a complete waste of time and general equities were the place to be because the capital rotation event had taken place in favor of the stock market. And then you get another rotation event, took place in roughly the year 2002, in fact, when you got the breakout. And in those early 2000s, you should have been rotating out of stock markets and into precious metals, because as this rotation event took place, the S&P fell 50%. Okay. And then the chart goes up and up and up. And you can see here in 2008, there's a sudden acceleration as gold massively outperforms the stock market again. And what happened there to the S&P was it dropped another 50%. So the stock market dropped 50%. It tried to recover a little bit, and then it fell another 50%. And that's what drove this ratio upwards and upwards and upwards. And gold went from $250 to almost $2,000. So this is how we identify the rotation events. And this is building into another rotation event. It's a big, big rotation event that's taking years to play out. And when it happens, we will be able to spot it precisely using this chart. We can see the support level, 0.4187 on the ratio. The ratio is dropping because the stock market is currently outperforming gold. When it bounces, which it will, and moves upwards through the breakout line, and particularly when the ratio moves above 0.5, that's when you can absolutely confirm that this next rotation event has taken place. Gold has already broken out versus the equal weighted S&P. It's already broken out versus the Dow Jones, the Wilshire, and the Russell, but it hasn't broken out versus the S&P and the NASDAQ. We all know what's going on with Nvidia, Microsoft. They're both $3 trillion companies. Nvidia makes up 14% of the stock market. I suppose that must mean that Microsoft makes up another 14% because that's 3 trillion. So you can imagine what might happen or what will happen if and when those two particular stocks suffer any kind of an issue. I've written a post on our website today about the boy who cried wolf and the straw that breaks the camel's back. And the boy who cried wolf is the idea that there will be an article on Zero Hedge or an equivalent website every month of every year, going back as far as you like, saying that there's an imminent catastrophe coming for the stock market. And that's the boy that cries wolf, because you say it over and over and over and people don't believe it anymore. Mm-hmm. And that's where technical analysis really helps us, because we can see the wolf approaching. This is the wolf approaching, this ratio chart approaching the breakout. And that is when the wolf is at your door, 0.5. That would be perhaps when the stock market, if we take current values for the S&P, let's say it's 6,000, you would need $3,000 gold to have a ratio of 0.5. But if the stock market starts to fall somewhat and comes down to 5,000, then you only need $2,500 gold to be at that 0.5 level. Mm-hmm. Now, if you didn't have this ratio chart, you might not realize the significance of what that means. Okay, so stock market comes down to 5,000 and gold's at 2,500. So what? Well, so what is that it's broken out through a critical level on a technical chart that tells you a rotation event is taking place. And the straw that breaks the camel's back in that article that I wrote is all about something that is there's going to be a crack that appears somewhere, just like it did with the Lehman event. back in 2000, was it 2007, 2008, and the banking crisis and all that kind of stuff. It starts with a small crack that appears somewhere in the world of finance and economics, geopolitics, whatever it happens to be. And it might seem insignificant, it might seem containable, but it spreads, and it's some sort of contagion that's going to take place. And this chart is telling us that there's a very high probability of that taking place over, well, probably during 2025. It could get pushed right to the end of 2025 into the early part of 2026. But my gut feeling is that it's going to probably be in Q2 of 2025 that this thing start to really sort of fall apart. But the technical charts will, as I said, give us the tell us everything we need to know about that. So the straw that breaks the camel's back, the boy that cries wolf, it's all about getting the message right as a technical analyst, because narratives and fairy tales will lead you down the garden path and lead you to huge losses in your portfolio. If you'd believed people about gold going to $10,000, silver to $1,000, and the stock market collapsing, they've been saying that for goodness knows how long, and it just hasn't materialized. But there is a time to give those sort of strong projections and with a strong conviction, and that is when these technical charts give us the confirmation. So it's all about the timing, it's all about the messaging, and it's all about the evidence, and it's the weight of evidence, not just one piece of evidence, not one chart, but it's all that weight of evidence that's brought together in a scientific way that will give you the correct assessment in terms of probabilities, never certainties, but probabilities, correct assessment of what is likely to happen next. So hopefully that's given you and your viewers something to think about. And those that are a bit skeptical about technical analysis, hopefully it'll have helped to at least give them the idea that it has a place when it comes to trading and investing.
Absolutely. And I would just go back to a point that you made earlier on, and I see this quite a lot, and I think it's crucial when you pointed out the differences between being an investor and a trader, for example, that actually if you're trying to generically invest in the market or trying to trade a market, and I've pointed this out before on Substack, is you need a different mentality. So what I mean by that is that you see a lot of people, some other Substacks that I follow, and someone is doing their analysis, and then people seem to be quite quick to chuck the toys out of their pram. It's like, well, the silver price has gone down by $1 or whatever it is, or my trading account is X, Y, and Z, whatever it might be. But if you're then holding the physical silver, I'm just using silver as an example. If you're holding a physical silver and it's in your house or it's in bullion storage, wherever it might be, actually you've probably done that for a very long-term view. So a silver going up and down by $1 probably shouldn't cause you to lose sleep at night. Whereas if you're trading it, like you were pointing out earlier on, it's working using the technical charts as you've pointed out, working out your entry points. Then when it gets to a certain point, that's your exit point, or certainly a take profit scenario. And I know trading's easier said than done, but again, it's that patience and looking at the technical analysis like you're doing, and say, this is what's going on. But now I just wanted to highlight that it's that mentality difference, I think, between the sort of buying and holding bullion, for example, in comparison to.
There are 2 points on that as well. One is that they're not mutually exclusive. You can do both, and I do both. I have long-term positions, and I have what I refer to as a NAV, and your net asset value is your NAV, and that's that's your pot, if you like, that you are using for your trading, and they're not mutually exclusive. You can do both. And the second point is proper, sound risk and money management, and we are absolute advocates of that, and cannot stress how important it is. And what I mean by that is that if you're doing it correctly as a trader, you can have 75% of your trades not work out, but you can still be making profits overall. So even with just 25% winners, your net asset value can go up. And if you don't quite understand how that can possibly be, then you're not using correct risk and money management. The way it works is that you, at the point you're entering the trade, you identify your stop loss,
Mhm.
the entry point, and the profit limit. The profit limit is your target. Now, if you hit your stop loss, if you've set it up correctly, you will lose probably no more than 1% of your NAV. So if the trade goes against you and you have to exit because your stop loss is hit, you would lose 1% of your NAV. That's the amount you're risking. Okay. It's not your position size. Your position size could be, all of it. If say you've got £100,000 to invest, your position size could be £100,000. It could take your entire NAV in in that one trade. But if your stop loss is hit, you're only going to lose 1,000.
Yeah.
Okay. It's not a statement of how much you're buying, it's a statement of how much you're risking. So you risk 1% on that trade. Now, if that same trade reaches its profit limit, you should be making 3 or 4 times as much. A 3 or 4 to 1 reward versus risk is what you should be aiming for. So if you have a 3 or 4 to 1 reward versus risk, then you only need 1 out of every 4 to succeed and to reach its target, and you're actually making a profit because you will be getting $4,000. So you'll be losing 1,000 if it goes wrong, but you'll be gaining $4,000 if it wins, and that will cover your next 3 losses, and you'll still be in profit.
Yeah, absolutely. I think that's. Thank you for making that point. I do see that, in my time of being online, that people are very quick to throw their toys out the pram, and I do wonder if that's because, as you say, they haven't necessarily thought of sound fiscal
Well,
management.
they're risking too much.
Yeah.
If they're just, if you can't sleep well at night,
Mm.
if you go to bed at night panicking that, or worried that something bad might happen, it's because you're not using sound risk and money management. Fine, if you're a risk taker, then go for it, but that's not the way to steadily and reliably and safely
Mm.
grow your NAV at a rate greater than inflation. If you want to make 10, 15, 20% a year reliably, then that's the way to do it. If you want to make 100% overnight, then you've got to risk everything. And this is why the crypto crowd really scare the heck out of me, because they are such risk takers. And I know for a fact that a huge percentage walk away from the table with losses. Um, so it's not something to be recommended.
Well, fair enough. Well, I think, Kevin, I just want to say a massive thank you. I think we've covered a lot today. As I said, what I think will be interesting, if it's okay with you, is looking at the technical analysis that you provided. I think, to me, from what I've seen, 2025 could potentially be quite interesting, for want of a better word. Maybe we touch base in the middle of next year and see what's going on, if that's okay with you.
Yeah, that'd be great. Look forward to that. Yeah, we'll see how the capital rotation process is unfolding.
Yeah, absolutely. We'll look at that. As I said, what we'll do is I'll put links to social medias in the Substack post. But people do want to find you, it's northstarbadcharts.com. And then on X, it is at Northstar Charts.
Charts, yeah, at Northstar Charts.
Perfect. Well, Kevin, well, thank you very much for your time. Really, really enjoyed that. I certainly learned a lot. So I'm hoping that people that watch the video as well do learn a lot as well. And again, if you listen to it on podcast format, I'd highly recommend you go and watch the video and see Kevin go through the charts. And have a fantastic day, and look forward to catching up in 2025.
Good stuff. Thanks.